Hello, welcome to the next of our ACCA P2 lecture recaps. This is a recap of the full course lecture available on our website, which is shown at the bottom of your screen. Also on that website, don't forget you can download this or all of our mind maps as a PDF for free. So we're now starting to get into the statement of financial position. So we need to know how to do the workings for that consolidation process. So how are we going to do it? Well, the first step is to use the acquisition method that we set out in IFRS 3. We talked about it last time. IFRS 3 outlines the acquisition method, and we're going to use that on which to base all of our workings. The first step we said then was to identify the acquirer, i.e. identify the parent, identify the subsidiary. We then need to determine the acquisition date, and we know now that will be the date at which we obtain control, because we talked about that in IAS 27. So we need to determine our acquisition date, and then we need to recognise and measure our liabilities assumed and the identifiable assets that we've acquired. We'll then measure our goodwill or bargain purchase, and we'll calculate our non-controlling interest. Lastly, what we'll do is we'll look at our reserves or our retained earnings, and we'll do a working for that as well. So the first working we looked at was to identify the acquirer and the acquisition date. So that's the first step in the acquisition method under IFRS 3. So how do we do that? First thing we said, read the question. Read it really carefully, identify who the parent is, and identify who the subsidiary is. You then want to identify the percentage ownership. Now, they may not give you just saying that the parent has acquired 80%, say. They may say that they've acquired 80,000 out of 100,000 shares, and you'll have to work out the percentage from that. So identify the percentage ownership, and that will allow you to identify the percentage of the non-controlling interest, the NCI. Then we want to check the date of acquisition. Make sure that you get the date right, because that will feed into all the rest of your calculations. So check the date of acquisition. Get that all down in a working and call it working 1. So this is the first step in any statement of financial position or even income statement for consolidation. Working 1, group structure. So you can see we identified the parent, they control the subsidiary, we've got the parent's interest, the non-controlling interest, and the date of acquisition. All of that needs to go down on your working 1. And we did that for illustration 1. The next step was to recognise and measure. What are we recognising and measure? Well, the net assets. Remember that the net assets that we're acquiring will be the share capital plus reserves. We're buying the company. You're buying their shares. So you're buying their share capital plus their reserves. That is what has been purchased. We need to know the fair value of that. So we're going to call that working 2 our equity table. Remember, it's our equity table. It's a credit balance. So we'll have our working 2, which outlines our share capital and accumulated profits at acquisition, and our share capital and accumulated profits at the year end. And again, we did that for illustration 1. That brought us on then to our goodwill. So what are we talking about when we talk about goodwill? Well, remember, the recognition and measurement was under our IFRS 3. And we were thinking about our consideration less the net assets acquired. So we called that working 3. That's our goodwill. So we took the cost of the parent's investment. We subtracted the parent's share of the net assets at acquisition from working 2. So the cost of the parent's investment less the percentage of the net assets that they have acquired gave us our goodwill. So that's our working 3, that's goodwill. And we did that for illustration 1 as well. That left us able to calculate our non-controlling interest. So we to calculate our non-controlling interest, what are we talking about? Well, it's called the non-controlling interest, and it's basically the bit that we don't own, the bit that's not owned by the parent. And we're starting off at the reporting date. So the non-controlling interest is the bit that we don't own, firstly at the reporting date. So working 4 will be the non-controlling interests percentage of the subsidiary's net assets at the reporting date or at the year end, depending on when you're asked. So the non-controlling interest percentage of the subsidiary's net assets, and that's our non-controlling interest. And we did that for working 1 as well. The last thing I mentioned was reserves. So what about our reserves? Well, the reserves will be the accumulated profits of the parent. So the accumulated profits of the parent, but we need to add in a share of the subsidiary's post-acquisition profit. We need to add those together. So we're adding together the accumulated profits of the parent plus their share of the subsidiary's profit since acquisition, and we'll add those together. This is our working then. The parent's accumulated profits, adding in the parent's percentage of the subsidiary's post-acquisition profits. Because remember, after acquiring the subsidiary, some of those profits are going to belong to the parent, so we need to add those in as well. So we did that for illustration 1. So those are our 5 workings that we're going to set up for every one of our examples. Lastly then, that enables us to prepare the group statement of financial position. So we need to add across the assets. So we're adding the parent's assets to the subsidiary's assets. We do that for non-current assets and for current assets. We then remove the cost of the subsidiary from the parent. Remember that in the parent's own accounts, they'll have investment in the subsidiary. You need to take that out because what we're doing is we're dividing that up. We're putting all the assets in, we're putting all the liabilities in, and we're putting goodwill in. So we need to take that cost of investment out. Share capital and reserves. Well, remember, the share capital is the parent only. The reserves will be our working 5. And we also then add across our liabilities. So adding across our liabilities, just like we did for our assets. Again, we prepared that for illustration 1, and then we did illustration 2 as well. So that was our lecture 3 on group workings.